Part 2, Ram's investment philosophy and tech trend. So regarding the investment philosophy, you mentioned about your approach is internet scale investing, right? Many of your investing bets is related to the big trend. You capture them in the early stage. If you look at the past, you've done that. Great. But what does it mean now if you're sitting today and looking forward? Everybody talking about AI in the LP conference. I saw many CEO, young startup founders talking about the tech stacks. Give me one or two examples to reflect your investment philosophy. How do you really spot this opportunity?
Yeah. So Jeff, the investment philosophy sits on 4 pillars. I look for 4 things in every company. Number one, I look for quality, and I'll define what quality means to me. Second, I look for growth mindset or growth behavior. We're not value investors. In fact, value investing in tech will not make money for you, in my humble opinion. It's too hard. Number 3, I look for durability of revenues, durability of free cash. Ultimately, the ultimate truth is free cash flow per share, because in technology companies, you have dilution. So what is the durability of revenues and the durabilities of free cash flow per share? And number 4, am I buying it at a reasonable price? I'm not a momentum chaser. And underlying this is deep fundamental work, and do I have some variant perception? Okay, so those are the 4 pillars of how we buy any company. It doesn't matter whether it's, and also remember, within technology, we only have 4 sectors we cover: internet, payments, software, AI, semiconductors. Okay, so the question is, how did we even come across these 4 sectors? Because guess what? When I started my career 15 years ago, the best space was consumer internet. Then you had payments. Then we had software. Then I actually thought semiconductors will never come back, but after the chat GPT moment, we have to cover semiconductors, right? So you see, this is a layer cake of where the world is going. And is it secular in nature? Is there durability of revenues run by world-class management teams, quality, with a growth mindset? And can I buy it at a good price? The 5th sector we are adding, and I think I announced to you at LP Day, was physical AI. What happens when AI interacts with the physical world? And so the first way we are expressing our focus is on robotics, and within robotics, autonomous vehicles. So we're looking at the entire stack of autonomous, because an autonomous vehicle is just a robot that carries you from point A to point B, or carries goods on a truck from point A to point B, or carries food from point A to point B. It's a robot. So you see, so the next area that I think is going to change is physical AI, right? So first of all, we're always looking for what is the next horizon to grow. Another example of new horizons are, I think India is in a secular growth market now. So we're going to do our first India trade in this fund next week. Just the way China was a secular growth market 15 years ago, and maybe it'll come back. I don't know the answer. If it does, we'll invest in China again very happily. But today the opportunity is in India. So we're going to go back and we're doing our first India trade. So you see, we're always looking for new horizons. So that's number 1. Number 2 is, let's talk about the quality bucket first. Quality for me falls in 2 buckets. Number 1 is in the quality of management team, and then the quality of business. So what are the unit economics for everything in that business? That's 1. Number 2, growth mentality. Now remember, technology is about new S-curves. So we had the PC era, mobile era, data era, cloud era. Now we're sitting in the AI era. Now it doesn't mean the previous 5 things have gone away. They still exist. In fact, they are the guys driving the AI era today, right? In fact, what's old is new again. Technically, we started the first growth curve in 1970 with Shockley semiconductors. Technically, that's what happened, right? And it turns out that 60 years later, we've come full circle again, where semiconductors is driving this new revolution forward. Okay? Can the management team and can the subsector create new growth S-curves? And the way a management team typically does this is not only jump onto an S-curve, if it's an old company, create a new vector of product growth, new products. Okay, so think about it. Amazon started with selling books. Then it sold other things as a warehouse. Then it built a third-party business. Then it built a cloud business. Then it built a prime business for entertainment. Then they built a media business. right? They built an ads business. Now they have an AI infrastructure, which is going okay, not great, but they're building a robotics business. It's crazy. They're going to put like a million robots in their warehouses and everything else. So you can see it even in where I live. In New York right now, if you live in New York, you'll see that Amazon robots deliver things up and down a street. Incredible what is happening. And I'm sure that's the same thing happening in China. So you see my point. There are always new vectors of growth, and I want management teams that can capture that and grow the business. That then becomes, oh, if they do it right, can you build durable revenue streams? So even if one revenue stream is slowing down, will the next one come to drive it forward? And the magic and the analysis, because often happens is when you're giving a new revenue stream, it's highly gross margin negative, which compresses earnings. Okay, then do the unit economics. Okay, if this works, in what time frame do you think that'll work its way down to earnings? And then last but not least is the price. Are we buying it at a mid-cycle multiple or not? Is the company willing to buy back shares because we pay for stock-based compensation? Do they care about minority shareholders? Because you and me both know how many management teams do not understand the concept of capital allocation. So that is the way I think about all companies. So today, as I sit here today, I see I'm actually I'm excited, but also slightly nervous. So I'll talk about why I'm nervous and why I'm excited. Because so I'm nervous, Jeff, because nobody else is nervous. Man, the amount of excitement right now worries me. And again, we have this ringside view where we meet the best venture capitalists in the world. My wife runs a world-class venture firm. She brings all these young VCs and young operators. They are, at this point, what is very concerning to me in the Valley is nobody is imagining failure. It's really worrisome. Today, it's funny, right? Today, OpenAI did this announcement with Microsoft, and it's a pretty well-known secret in our circles that OpenAI and Microsoft hate each other at this point. OpenAI basically did this for-profit transition, which is going to be great for shareholders. My wife is an investor in OpenAI from Y Combinator, so hopefully we'll see some carry checks soon. They made the transition, and then what they said is we told Mike, they said we're going to write a $250 billion contract with Microsoft, which is a made-up number. That number doesn't exist. And then they said that, we will no longer be required to use Microsoft Cloud Services. So they got out of the right of first refusal. And Microsoft stock is up 4%. Everyone's, yes, let's go party. And I'm like, hold on. Microsoft stock is driven by one thing, which is accelerating Azure.
Yep.
If OpenAI no longer has to use Azure, they will switch to somebody else and most likely to Oracle, which is basically cutting prices at the cloud level. Isn't this bad for Azure in 6 months? So I asked the question to two of our prime brokerage sector specialists, and one of them actually responded saying, sure, if you want to be negative. And I'm like, that's an interesting response. So everyone is warped into this crazy bullish market, and that's what makes me nervous. Now the question is, all right, Ram, you're being just panicky for no reason. So I'm not panicky at all. I'm actually very excited. But when nobody is skeptical, I think it is important for us at Octahedron to be a little skeptical and at least imagine what could go wrong.
So what will you do at this moment? Then what is the action you're going to take?
There's nothing to do for now. So I'm not panicking. So it goes from different levels of feeling. It goes from let's do all the work to make sure we're not missing anything, to let us still check if the earnings revenues are durable, because we ingest so much data from so many sources. Is the quarter still, it goes back to very traditional doing, Jeff, and discipline. Is the quarter fine? Is the year fine? Do we have asymmetry in our prices or not? It's very simple. I'm a bit of a traditionalist that way. Like in a world where everyone like pushes AI, I'm like, let's go back to human thinking. Do we have confidence in the quarter? Do we have confidence in the earnings for the next year and couple of years? And is there asymmetry in what we are buying? Or is sentiment too far ahead of itself? By the way, I have no FOMO of cutting if the sentiment is ahead of itself. There is no need. I could be wrong. The market will take the stock up another 30%. Maybe it will. And sure, I missed out on the incremental. I don't care that much. Because I'll buy something else, which will be the next driver of our returns. So that's number one. Number two is The good news is we are not panicking right now. We are careful in doing the work, but we work in the public markets, Jeff. I can sell the entire portfolio in 15 minutes. That's why I like liquidity. Like I always imagine if something really bad happened, I'm like, I'm out. Go to cash, and then assess. That is actually the biggest lesson I learned from our difficult times in 21 and 22. And I think one of the best is, so you talk about Kotu as a firm that you admire. I admire Kotu as well, but I think their returns are okay. But I think what is great about Kotu and Philippe is actually his risk management. And I've not had a chance to talk to him about it. But I think because he started the firm in a very difficult time. I think in 1999, 2000, after everything had crashed and burned, he did a podcast where I felt like he did not get any money from anybody to build his firm. And he was really struggling. He was walking in the wilderness for years, 3 or 4 years. I remember the tech markets never came back for 3 years after that. And he went through a lot of misery and pain with a lot of ups and downs. And that is why he's a good risk manager. In fact, in some ways, I think we got lucky when the firm was still young to go through a very deep correction. And so we, I think, really focused on risk management. And that is what has performed the way it has recently because we have done really well through big drawdowns. So the nice part about our risk management is that I'm not panicking. I think things are fine for now. Rates are going to go down in America at least. That is good for long-term assets, long duration assets. It's probably not as good for the non-10 S&P, the highest quality growth assets, because inflation will bite the consumer. We are short a lot of the shittier services and shittier businesses. So that's why our short book has done so well this year. Our long short and long only performances within 3 points of each other, both in the 40s. So our shorts have really worked. And we are running a 29% net book right now. So a lot of short exposure. There are lots of interesting things to do even today, even in a very bullish market. And so my sense is that there are three big themes you're playing for. Number one is physical AI and the real transformation of autonomous vehicles, just creating an entire system of autonomous vehicles in the world. Our biggest position is Uber actually to play the trend because everyone thinks Uber is disrupted by AVs. I think it's going to be a beneficiary. We talked about that in LP Day as well. Number two is I'm a big believer in global financial banking infrastructure, the next generation of banks, which is why we own a lot of new bank stock. And AI really helps these companies to an extreme way. Better fraud detection, better customer support costs, and then that cost structure actually goes down dramatically. That's number two. Number three, everyone hates software right now, as software is dead. We've actually gone and taken a very large position long in a software company, but actually adding to our software exposure with the bet we are making that actually it's not going to be that hard. These companies specifically, very specifically, have the capacity to, and they have showing some evidence of turning the corner. If they do that, we're going to have a great next year because we now are actually cutting our semiconductor exposure and adding our software exposure back up again. Just when everyone hates software. So you see, we have to be a little asymmetric. And by the way, if we get evidence that more frauds, more evidence of demand slowdown. So right now we only see one data point of demand slowdown in AI, only one, which is that agents for enterprises are not working. So everyone thought that this is going to be the year of agents for enterprises. It is bad out there. Nothing is working.
Is it already some sort of consensus on that?
You heard it here first. We don't talk about it too much because we can also go short some things on the back of that. My point is, because you asked the future, my point is I'm excited, but everyone knows the bull case in AI. Everyone's jumping up and down saying AI. I'm like, actually, it's important to ask what could fail. I'm not panicking yet. I'm not worried yet. I'm looking for where can demand slow down. And I think the first exhibit of demand slowdown really is the fact that enterprise agents are not working at scale. It's not easy to build them. It's a slow process. I also want to see if there is any sort of slowdown on the consumer side, because there is a very interesting data point on OpenAI, which is OpenAI growth, DAU growth has flattened. So total number of people using OpenAI on a daily basis is slowing down. OpenAI, I would argue, is the poster child for AI today. It is the name for AI.
Yeah, that could be a huge potentially challenge. You see, these days, lots of valuation is built around OpenAI, right? Either they're buying tons of chips or use the cloud service. Almost. So if there is a slowdown on the OpenAI in the business, would there be a correction in this whole
Yeah, I
industry?
think, listen, so first of all, OpenAI is still crushing it, right? They've got lots of capital, they are releasing lots of products, they're doing some very incredible, innovative work. No question about it. And I would argue today that, listen, the delta to the competition was very wide, let's say even 18 months ago. The delta to competition is very narrow right now. It's very difficult to distinguish one
Mm.
versus the other. Yet, because they've gone to a scale of 800 million plus weekly active users, people's behaviors have changed. They've done a great job of changing people's behaviors. You have to give them credit for that. The problem with consumers is that consumers are fickle. Their switching costs are zero. You can
Yeah,
open one screen ChatGPT, one screen Gemini, and you will just come down to, so ultimately, these are commodities. Information discovery, Jeff, is a commodity. In a commodity, you and me both know that the lowest cost player is the one who wins long term. OpenAI is spending so much money, they need more capital to get to the scale and the dreams people expect off of them. So it's never going to be a straight line, but they are still excellent at what they do. What you should be worried about is those promises they have, whether it's with chips or contracted revenues or contracted cloud costs. Everything is cancelable. Backlogs are cancelable. It's an indication. Today, Jensen came and said he's got $500 billion of backlog. I'm sure he has it. How much of it is double ordering or
mm,
quadruple ordering or 10
mm,
times ordering? It's like an IPO. You always give 10 times your demand because you know you're going to come back. There's no real demand. This is the
mm,
same story here.
mm.
So yes, they're geniuses. There's a lot of demand right now. There are very few dead GPUs in the world, especially in the leading edge. There are some dead GPUs or dark GPUs when it comes to lower, older stuff, especially Southeast Asia, but that's all fine.
Mm.
Generally, there's still a lot of demand for compute in the world. Generally, the biggest companies, I'm going to trust their demand characteristics, whether Google, Meta, ByteDance, Alibaba, they have infinite demand, incredible stuff. The cost curve has to come down, right? Otherwise, it's too unaffordable. The power requirements have to come down the cost curve, else
Mm.
it's too unaffordable, especially in the US. We don't have the capacity. So I do think, though, there's a hype cycle, but I don't think there's a bubble yet. I think things are slightly frothy. But for example, let's take Nvidia. Nvidia is a $198 stock today. So me and my analysts were redoing the work today, and we think in 2027, because now we can look out 2 years. Now, for semiconductors, we don't look out 3 years because it's too cyclical. But we can look at 2027 now. We think there's between $8 and $10 in revenue, in earnings. So let's say $9 in the middle. Let's say, and I think consensus at 7, but we're 8 to 10.
Mm.
Let's say it's 9. The stock is cheap at 195. There is no bubble in Nvidia. That's 22 times earnings. That is the same as the S&P. There is no bubble in Nvidia.
Mm.
So that's number one. Now, where there is a bubble and where there's froth and where there's some grift and some scams, is all this stuff in non-revenue nuclear centers, quantum computing, which is many years away for execution. That is basically the scams and the grifts that happen. There's nothing going on there.
That's exactly the question I would like to ask you about. Was my next question is about your view on quantum computing. So that's great. You mentioned about it. So let me hear.
So first of all, right, quantum computing, the reason why people are, I actually don't, quantum computing is a thing. Of course it is a thing. It's been a thing for 20 years, by the way. We're now seeing the first versions of quantum computers being made. IBM did it. Google, by the way, is making some rapid progress in quantum computing.
Yep.
It is very hard to compete with the scale of Google and IBM resources for a
Mhm.
startup or for a private company that has nothing going on. Some of them are scams, outright scams, by the way, to be clear. But we're in that market where the animal spirits are willing to trade these for, it's a game, and it's a video game. But those are video game stocks. Ignore that completely. Computing will have but the reality is quantum computing, I don't think will look like cloud computing. It'll be used for very specific corner cases because the I/O, the inputs and outputs into a quantum computer is painfully slow. You cannot use it for traditional computing. This is the equivalent. Remember back in the day when we were growing up, Jeff, we would talk about supercomputers, the crazy supercomputer,
Yep.
which, by the way, has less computing capacity than most cloud-based systems. Think of this quantum computer as the Cray system of tomorrow. It can be used for very specific use cases
Yeah,
in
drug
very
discovery and
specialized
all. Yeah.
modules, in cryptography, in solving protein folding. There's just a lot, but to take that concept, which is only now getting some real world product and saying, okay, this is the future, in my opinion, is premature. So, Jeff, to your clients, if you expect us to make money on fads, we are not the right fund for them. We will not be able to. We like to make money the boring way, which is we look for companies that, let's say, for example, very simply, a portfolio that compounds free cash flows per share at between 25 and 35% for the next 3 years. If we buy it at right prices, your portfolio will appreciate at 25 to 35% every year. That is the one line for Octahedron, nothing else. And it happens that these high rates of free cash flow per share growth happens in innovative, growth-oriented companies. Slower companies cannot get there. Or if we buy a slower company, it's at a massive margin of safety where we are playing for a re-rating. Irrespective, my point is quantum, like these bleeding edge things are not the ones for us. You should invest in my wife's fund for that. She does
Right.
this stuff all along.
That's exactly also a similar question, is that right? So you're a public fund, you think quantum computing is way too early and could not even match the scale in reasonably short period of time. But in your wife's fund, when you look at the quantum computing right now, the valuation of this kind of company, the market cap is actually not that cheap, right? So the question to you is, will Anu look at quantum computing as an opportunity?
Yeah, so I think so. By the way, first, I don't want to talk for her because she's a intelligent investor on her own. But I will tell you that because it is a venture fund, B and C venture fund, never say never. Right now, I don't believe they have anything speculative with the portfolio. They have high quality next generation AI companies, the stuff that will go public in 3 years, if we can start buying it, or we will build a late stage fund and we'll buy in late stage in public markets. I don't think she has anything speculative. That said, by the way, there's a company called Rigetti Computing. I
Yep.
think it's RIGT,
Yep.
and she was the Series B backer back in the day. So
Okay.
she invested in. So yeah, so she's so or Series. I don't know. She put some money in Chad Rigetti because it's a YC company.
Yep.
So I think she definitely has the capacity and the interest to do hard tech. But I think if you ask her, she'll tell you it comes down to betting on a world-class founder, especially in times when things are very asymmetric. But remember, asymmetry happens in the private markets, even in general technology, right? Even something as simple as Google, there is asymmetry, which we discovered 1.5 years ago. So my wife, as an example, let's give you as a case study. So remember, as this concept of 15-minute e-commerce has been a graveyard for capital for years. Billions of dollars went into doing 15-minute commerce. In China, we had the equivalent of community group buying to really, they would have these CGB stores at your apartment complex entrance so you can quickly go up and deliver food or groceries in 10 minutes. And it's failed all over the world. But she took a big bet on one company in India called Zepto, because India is the only country in the world where 15-minute commerce works because there are rich people and poor people, and nobody wants to go out because the weather is too hot or the roads are too bad. So you see, it's perfect country for 15-minute commerce. And so she took a big bet on a company called Zepto that'll go public next year. And she owns 15% of Zepto, and it'll be a $10 billion IPO. So you see my point. Whether private or public, Jeff, I think what me and Anu are trying to get better and better at is this concept of asymmetry. But in our fund, at least, just jumping back to Octahedron, don't expect us to just trade momentum, especially if we don't believe it's sustainable. Because remember, there are 4 pillars: quality, growth mentality, durability, and good price. So you take quantum, for example, it fails all my 4 tests. I don't think the management teams are any good. I don't think the business is durable. I'm not buying it at a good price. And I don't think these guys have growth mentality. They are very good marketers, but I don't think I have growth mentality. So it fails all my four criteria. So why would I even touch the stock? Now, sure, the stocks are up 15x. We missed it. I don't really care because, again, our LPs are not investing in us to be speculators. Our LPs are investing in us to put high rates of return so they can put lots of capital to work with us and they know the money is in a good place and is being responsibly invested.
Yeah, I think that's excellent. So I think that's you stick with your investment style, and that's what the LP loves. They don't really expect you to kind of you're chasing around all the hard stuff. So you have this four pillar for identifying the right stocks. I think that's great.